Well, for more analysis on China's latest economic data, let's head to Montreal now to talk to Yan Wang, Chief Emerging Markets and China Strategist at Alpine Macro. Welcome back to the show.
Thank you for having me, Rachelle.
So let's start with your take on how China's economy is faring 9 months into 2019.
So far this year has been pretty challenging for the Chinese economy. The latest numbers are telling us that growth has, probably still deteriorating. At least there's no sign that the economy has stabilized or has begun to improve. So I think the reasons for that is, number one, you mentioned, we have the trade tension with the U.S., we have the trade war with the U.S., but on the other hand, we've seen insufficient policy support by the Chinese policymakers to support domestic demand. So I think the combination of the weakening exports combined with insufficient policy support, I think that's the reason why the Chinese economy has continued to remain very sluggish so far.
Now, you mentioned a number of challenges. What sort of impact are they having on the economy, and how should China be better addressing these challenges?
Well, I think from cyclical point of view, obviously we know when the economy is slowing down, policymakers need to respond to that, and we are seeing the Chinese policymakers, or the central bank, for example, they have been cutting reserve requirement ratio. They have been allowing the RMB to depreciate. From that point of view, these are the kind of policy reflation that is badly needed to support domestic demand when your exporters are struggling. I think this is purely from a cyclical point of view. That's absolutely necessary. But on the other hand, to address the structural issues, we are seeing this kind of intensifying trade war between China and the U.S. And for China to gain some support globally, China needs to remain open to foreign businesses, to remain open to foreign investment. On the other hand, China needs to deepen structural reforms to improve the efficiency, to improve productivity. I think those are the things that Chinese government should begin to do to help to improve the long-term prospect of the Chinese economy.
So how deeply are companies in China feeling the impact of the trade war, and how are they adjusting their strategies?
I think at the micro level, at the corporate level, I think different companies may have different strategies to deal with the headwinds in the economy. But actually, purely from a macro point of view, there's not really much companies can do, right? So when the economy is slowing down, companies need to retrench. This is the kind of downward spiral that may develop if policymakers do not step in. So I think in this kind of environment, there's really not much companies can do, right? They can now, if they are facing this kind of structural headwind from the trade tension, from the trade war, if the trade war lasts a bit longer, then they will have to rearrange their supply chains to avoid this kind of uncertainty. But I think at this moment, what's necessary is policymakers need to step in to boost the domestic demand, to avoid this kind of potential downward spiral in the economy to develop. I think that's the most important thing to do at this moment.
And you mentioned the moves being taken by the central bank, the People's Bank of China. How are analysts interpreting what the PBOC is doing, and any perhaps future cuts or adjustments?
Right. I think that should be a very important positive development, in the sense that this serves two purposes from the central bank's point of view. Number one is they cut reserve requirement ratio of commercial banks. That this step allows the loanable funds of commercial banks more available, right? So they releases some idle resources from the commercial banks so that they can make new loans to corporate borrowers, number one. Number two is also the reserve deposits in the central bank. They are, the central bank doesn't really pay interest. So basically this is cash sitting idle in the central bank, so by releasing these required reserves, this can actually reduces the average cost of funding of commercial banks, because if banks, if they borrow from the interbank market or they get liquidity from the central bank, the cost is a lot higher than the required reserve deposits. So by doing that, it can lower the cost of funding of commercial banks, so that the central bank can hope they can lower, commercial banks can in turn lower the cost of funding to the corporate borrower, so they can lower the interest rates of the entire economy. I think this is, to me, I think this is a very important positive development.
All right, thank you so much, Yan Wang there, Chief Emerging Markets and China Strategist at Alpine Macro.